Today's video would focus on 7 dividend stocks for when the going gets rough. The twists and turns of recent times have investors sitting on pins and needles. While the stock market sentiment remains positive, there are several concerns, especially with the turbulence the COVID-19 pandemic can cause in the financial markets. However, before we get further into the video, please take a moment to subscribe and to put on post notifications so you can get informed every time we upload a new video. Also, make sure to like this video and subscribe to our channel for more. Without delaying another moment, let's dive into this video. How can you prepare for the unexpected and unpleasant? One way for investors is dividend stocks. We particularly consider commodities, energy, and real estate to be a better defense against inflation. That said, we'll be getting into our list of dividend stocks that you can invest in safely. Number 1. Broadcom, an American designer, developer, manufacturer, and supplier of software solutions. Broadcom is a technology company that leads globally. This company is active in the field of computer chips and offers a wide range of semiconductor and infrastructure software products that serve the data center, networking, software, broadband, wireless, and storage industrial markets. At present, Broadcom seems to be enjoying good business returns with plenty of cash reserves that can be used to pay dividends, buy back shares, or make acquisitions. The company recently attempted a failed takeover of SAS Institute. The acquisition of this software company was relatively cheap, costing about $15 to $20 billion, and has impressive prospects for growth. To look on the bright side, shareholders can now profit from the money that would have gone into acquiring that company. Either way, considering the low debt, the dividend can be regarded as a safe bet. Number 2. Exxon Mobil. Oil and gas is a known source of revenue, and Exxon Mobil is maximizing that profitability as one of the world's largest publicly traded international oil and gas companies. Unfortunately, during the pandemic in 2020, the company has notably lagged behind the rest of the stock market. Another reason for this lag can be the campaign against the use of fossil energy as a result of the environmental damage they cause, especially global warming. Regardless, there remains a demand, and the increase in oil and gas prices connotates potentials for solid profits. From the company's report, it made a profit of $4.7 billion in the second quarter. There has also been an increase in cash flow, reaching a peak level of the last 3 years at $9.7 billion. This would provide the company room to pay investors high profits and dividends while investing in future growth, especially in green energy and paying down debt. Number 3. Royal Oil. Also one of the largest unified publicly traded petroleum corporations in the world, Royal Oil and Royal Dutch Shell plc explore, produces, refines, and markets crude oil and natural gas. The company has its headquarters in The Hague, Netherlands, and has its presence in more than 90 countries around the globe, with 2 parent companies, NV Koninklijk Nederlands Petroleum Maatschappij, or the Royal Dutch Petroleum Company Ltd, and Shell Transport and Trading Company plc. The company's principal and largest American subsidiary is Shell Oil Company, or SOC. Last year in 2020, investors received quite an unpleasant shock when the dividend was cut. However, faithful investors are seeing rewards at present, as the shares have increased by 38%, which yields a dividend yield of almost 4% at the current price. Considering this, we think Shell is certainly worth investing in for investors with a need for fixed sources of income. Number 4. Realty Income. Realty Income Corporation is an American real estate investment trust that maintains a diversified real estate portfolio over 6,700 commercial properties, which are leased long-term to retail businesses. The company also owns non-retail properties, with industrial buildings comprising 12% of revenue. With over 630 different clients, Realty Income operates across 58 industries and is located in all 50 states in Puerto Rico and the United Kingdom. In June, the corporation adeptly capitalized on favorable market sentiment by issuing 7.25 million shares. It can make $1 billion investments and use $3 billion to pay off debts. The low debts reduce the group's sensitivity to possible future interest rate fluctuations. For the time being, the real estate group's sales and profits are performing excellently, and investors presently enjoy a dividend yield above 4%. Number 5. Universal Corporation. The names sound alike, but the company is completely separate from Universal Music or Media, and their functions are in no way alike. The Universal Corporation supplies leaf tobacco to manufacturers of consumer tobacco products, a prominent American tobacco wholesaler. The company is one of the world's leading merchants of tobacco involved in procuring, financing, processing, packing, storing, and shipping leaf tobacco for sale to companies such as Altria or Marlboro. Though it isn't as popular as some tobacco brands, the corporation is having good business results. The dividend has been increased consistently for 51 consecutive years, with the most recent being in May. Last year, as with many companies, Universal Corporation was affected by a decline in trade flows. However, with the lift of the lockdown and other issues affecting travel and transport, CEO George Freeman III expects global trade to pick up again. The reduced supply is also expected to increase tobacco prices. Number 6. Vale. Vale, formerly Companhia Vale do Rio Doce, is a multinational company in Brazil invited in metals and mining. One of the largest logistics operators in Brazil and the largest producer of iron ore and nickel globally, the company is a well-known and relatively stable name in this cyclical sector. The demand for metals needed for the sustainable energy transition also profits this company. The only factor that could possibly have so far caused a grumble from investors would be the minimal increase in the dividend, which, according to CEO Luciano Ciani Perez, is a sign of a prudent policy. Number 7. WP Carey. Last but certainly not least on our list is WPC, a U.S. real estate company specializing in hardware stores and department stores. Valued at approximately $18 billion and ranking among the largest net lease REITs, WP Carey is an enterprise with a highly diversified portfolio. It invests in net release commercial properties and specializes in sale-leasebacks, build-to-suites, and the acquisition of existing net leases. The company has had exceptional resistance and tenacity through crisis, and we expect an increase in share price, excluding the dividend. Those are our 7 dividend stocks you can count on in these moments of such uncertainty. What do you consider to be a sure bet to invest in? Let us know your thoughts on this list in the comments below. We are sure you enjoyed this video, so please go right ahead and give us a big thumbs up. If you haven't already, don't forget to subscribe to our channel and turn your post notifications on by hitting the bell next to the subscribe button, so you know every time we upload something new. See you in our next video.